Hello, welcome back. I really recommend that you watch this video because regardless of whether you are actually interested in Docusign, this can actually be very helpful in evaluating some weird reporting from other companies potentially in the future. And in this one, we're gonna be talking about Docusign. So it had its earnings report, and it's up almost 20% right now. So obviously, I took a look at our stock news module here and pretty much opened up a couple of articles seeing what happened with the company. And so the first one that I opened was this one, and then I saw that DocuSign's earnings for its fiscal second quarter came in at 44 cents a share, down 6% from a year earlier. And I'm like, okay, how is that even possible? This company used to be super losing money. So what is happening right now? How are they going? How are they getting there? And so I got a little bit curious, and the next thing is actually I took a look at, we have a module here in the tool, which is called Sec Filings. And I kind of took a little bit of a look at, I was talking about the earnings transcripts, and I kind of took a little bit of a look at what they were telling in the previous years. And I saw this, this is the quarter one report pretty much. And I saw this in one of the earnings. It says that we will present GAAP and non-GAAP financial measures, and non-GAAP financial measures, as you'll see, exclude stock-based compensation expenses, employer payroll tax on employee transactions, amortization or of acquired intangible assets, debt discount, lots of expenses that are actually pretty much excluded here under non-GAAP measures. Now, the companies a lot of time actually report for investors. Now, sometimes they are useful, sometimes they can actually kind of be disorienting. And so in this case, I kind of wanted to see what is the exact value if we are talking about non-adjusted, as they are typically called, EPS, for example. And so I took a look at this, which is a DocuSign announces second quarter fiscal 2023 financial results yesterday. And I saw this over here, and you will see that the GAAP net loss per basic and diluted share was 0.22 on 201 million shares. And the non-GAAP net income was actually 0.44. And this is a positive number because, of course, everything was excluded from here, as I told you earlier. So this can be very easy to get a little bit sort of like disoriented, as I mentioned earlier, because of this GAAP and non-GAAP presentation. And companies that are losing money, they tend to use non-GAAP a lot. Now, it's not only companies that are losing money, because sometimes they can actually do it for the correct reasons. But in this case, you have to kind of be a little bit careful because the company still loses money. They're not making money yet. And that's what we're seeing here. They have a net loss, a GAAP net loss per share pretty much over here. Now, they have a revenue that has the increase of 22%, as you'll see. And you will see over here that subscription has increased 23%, and professional services have declined 11% a year. An increase in billings here. And overall, you can kind of see what has happened with the company. Free cash flow, 105 million compared to 161. So yeah, let's go back to our tool now and take a little bit of a look at the actual company and the financial analysis here. And we will take a look at our metrics again. Remember, this company has been down about 80%. It was close to $300. Actually, it may have been more than a year ago at some point. But you will see that the P ratio is very high. And pretty much the price to free cash flow is still a positive number and a rather good one. I'm sure because of the adjustments in the free cash flow. More than likely because they're actually spending tons in stock-based compensation, I would think. We'll examine that, of course, but you will see that the company has also been diluting investors massively, and that also makes sense because the stock price was very high at some point, extremely expensive for what the company is, and this is why it wouldn't make any sense to be buying then. And let's see if it makes any sense to be buying right now. Now, the company has some liabilities compared to the free cash flow, but this doesn't concern me too much. It's not a very high number. Even though it's red, it's marginally red. Anything below 5 would be green. The revenue has been increasing, but the net income has been going down. I mean, you will see that it has been having some years that were worse, and now we're getting to a little bit of better time since 2018, but still it's in the negative. And free cash flow growth has been increasing over here. Again, this is likely because of some adjustments. We will examine that. And the equity has been growing as well. Now again, the company is losing money, so no profitability to be seen over here. But let's take a little bit of a closer look at the financial statements, which will give us the story of a revenue that has been growing from 500 million to 2.1 billion over here, and net income that has been in the negative territory pretty much consecutively every quarter and every year. Now, the balance sheet will tell us of a company that is actually obviously accumulating lots of money because of issuing stock. Additional paid in capital is where you see that, as you can see here, and the total equity has been increasing because of that, but you would expect a higher increase, and it's not higher because of the company pretty much losing money. And so when you are losing money, even though you are selling a lot of stock, it's tough to make equity, and this is where retained earnings come into play. They are getting more and more negative here. This kind of tells you already that the company keeps losing money pretty much. Now take a look at the cash flow statement, and you will see that we are starting with negative net income, and it gets to very, very positive operating cash flow over here because of stock-based compensation, which is an expense. And now you understand why they wanted to exclude the non-GAAP, they wanted to exclude the stock-based compensation from the non-GAAP measures, because that makes it look a ton better, like way better. And this way you're getting to profitability via excluding the stock-based compensation, which is of course not what you want to be doing as an investor. You need to be taking this into account because it's an expense. And so the non-GAAP measure can actually really dilute your opinion about this company. And you will see here that the capital expenditures minus 61 million. And over here, net cash from financing activities minus 400 million. Free cash flow again in positive territory, but we examined why. And you have to be super careful about looking at this free cash flow here and being positive, because this is a company that I wouldn't be positive about, no doubt. Now, if we take a look at our stock evaluation tool, it will tell us exactly what is happening. And you will see that the company has been growing its revenue tremendously through the years at a very high pace. So we can go high here. We can go even 20, 25, and 30%. This could happen. But the problem is the net income margins, which are getting, they are getting better, I guess, but they are still negative. So what we can assume is some marginal profitability. We cannot go too far. Maybe 3, 5, and 7, and this could take some time to achieve, or they may take even many years to achieve. So this is very aggressive here, this kind of net income margin. The company is nowhere near that. And the free cash flow margin that I'm looking at, 80, 90, and 100%, the typical one, because the company doesn't really, you cannot really use this kind of free cash flow margin over here that you see, because remember, the company has negative net income and they're making good free cash flow. And the reason for that is, again, the adjustments. And so this is why the tool has been designed in a way that it correlates free cash flow to the net income, because this way you actually directly see how much money the company really makes and how much gets adjusted to free cash flow. And you will see terrible numbers here. This is why I'm going with something that is a norm for a company that is making money, 80, 90, and 100. Now, all of these are assumptions that are very super aggressive and nowhere near happening, frankly. So just by looking at this company, I probably wouldn't even take it here, because it's very negative in what they are doing, of course. But again, we want to be examining their status in case they achieve marginal profitability. That's always a point that it's useful if you want to be buying a company that potentially doesn't make money, but maybe too cheap, and it could be an interesting investment opportunity. This is exactly what we're examining here with these kinds of metrics. And we can go even lower for net income margin if we wanted to. And so annual return of 13% is what we're going to be asking for. We hit calculate here, and you will see that even for these super aggressive estimates, we are still in the red, comfortably in the red actually. And this is why this company is not a buy right now, no doubt about it, and doesn't seem to be nowhere near a buy, frankly. Because again, remember, these kinds of assumptions that we made here are super aggressive, and more than likely nowhere near happening anytime soon. Again, remember, you could be looking at the report and see this number, the non-GAAP one, and think that the company is making money, but they are not. They're actually still losing money. Remember, this is the non-GAAP, so be very mindful about these tricks that can actually take you to potentially buying such a company when you probably wouldn't do that otherwise. So thank you for watching this. If this kind of helped you a little bit and kind of gave you some information about the non-GAAP and GAAP stuff, please leave a like, that helps a ton, and subscribe if you're not a subscriber already. Lots of these kinds of information over here. Hopefully we can help you a little bit. And remember, you can always become a patron and get access to this tool and everything that I have shown you here. I'll see you in the next one, guys. In the meantime, take a look at this video that I made earlier. It's about Microsoft. And I'll see you in the next one. Bye-bye.